Welcome to Subramani. A few investment advisors reached out to me saying, how should we tackle the customers' worries during a volatile market? So I said, give them one historic fact, whatever you call it, whether you call it a slowdown, you call it a pullback, you call it a recession, you call it a depression, you call it a fall, you call it a bear market, it doesn't matter. Markets have always recovered. It is not, I'm not saying that that all equity shares will recover. No, some will just vanish. But the index will always recover. A well-managed portfolio will always recover, right? So either you trust the fund manager and therefore you stay during bad times, or you be in the index during the worst time, and as soon as it goes up, you sell off. So you will benefit by investing during bad times, but it is now the skill of the financial advisor and the investor rather, to handle this volatile markets together. So down markets are always tricky because let's say the index went to say 85,000. And the client said, let us sell off something. And you said, no, you don't require money now. Why will you sell? So don't sell. Then the market comes down to 83,000. The investor will definitely tell you that, look, I told you we should sell at 85,000. You said don't sell because you don't need the money. You have no goals, right? Which is right. What you said is right, but the market has gone to 83,000 is also right. Then you say, look, market, even if it goes down, it will come up. He says, no, but I get a chance. I could have sold at 85. Now, if the index had gone to 87,000, he will not even remember this conversation. It's not that he won't tell you about it, he won't even remember this conversation. So down markets are always challenging, right? Always challenging as to how to hold on to the client's fears and not let him just jump around here and there and damage his portfolio. That's a very important thing, and all portfolio managers know that the markets will go down, markets will recover, all of that happens. So whether the particular scheme in which he has invested, for example, people come and say, last 1 year my fund has underperformed the index, the benchmark index by 10%. What should I do? I honestly don't know what to do, because if the fund manager is good, he may have taken some extra bets which may not have done well. For example, somebody who took a BFSI bet is not done too badly. But somebody who took an anti-BFSI bet and his benchmark against the index, he will get hurt because the benchmark has got too much of BFSI into it, right? So if you were into IT, you would have got hurt. But selectively, you could have made a lot of money in some shares going up and going down. So in IT, if you were in Infosys and TCS and Wipro, you wouldn't have done much. But if you were in HCL Tech, you could have made some money. So it's very difficult to say what is to be done and what is not to be done during a bad time. And let us also accept that whether it is the index, the S&P, the Sensex or whatever, if it falls for 1,000 points, right? So when the market is 8,000 and it falls 1,000, that is 12%. That's a huge fall. But when the market is 80,000 and it falls 1,000 points, it is good headline for your pink papers to say market crashed 1,000 points. 1,000 points is not a crash, right? On 80,000, 1,000 is not a crash at all. They may not use the word crash, but they'll say market pulled back. Ambani's lost so much money, Adani lost so much money, as though they are in the market selling their stake every day, right? So, but also, you know that disciplined managers don't think that you have to guess what the market will do, whether large cap will do well, mid cap will do well. Can you guess about the market? Answer is no. You might as well ask an astrologer rather than asking an analyst, right? You just go by the data that is available to you and the risk profile of the client. So if the client's daughter is 4 years old and he's saving money for her education, which he needs when she's 21 or 18, you've got 15 years to go or 18 years to go for that money to be needed. So will the market recover in the next 18 months, 18 years? That is what you're asking. And the answer is mostly from historical data. Answer is yes. So immediately somebody will say, look at Japan. Look, even in Japan, if you were doing the SIP and you could have held on to the SIP, you would have recovered your money much before than the one-time investor. And right, so knowing that is important. And again, Hope and fear are not investment strategies. Let me give you a personal example. When HDFC Bank fell, not now, but in the recent past, after Mr. Aditya Birla had left, and after Mr. Aditya Puri had left, and he sold his own personal shares, and he said, look, I'm just selling the shares because I'm not working in that company anymore. That's fine. He sold, but after that the market fell. He says he knew something was going wrong. And these are the same people who would not sell HDFC Bank, and I had to tell them to sell HDFC Bank because HDFC Bank was maybe 80% of their portfolio, right, or 70% of their portfolio. These are all ESOP holding guys who swore and still swear by HDFC Bank. That's fine. I'm not even getting into whether HDFC Bank is a good bank or a bad bank. That's not the argument. The argument is how much of concentration risk are you running in your portfolio. So if you're running a concentration risk, it is the job of the financial advisor to reduce the concentration risk, which means perhaps reduce the overall return, but also dramatically reduce the risk. This is very, very, very important. So if I had met somebody who had HDFC Bank 80% of his portfolio or 90% of his portfolio, I'd do exactly what I did for a technology company CEO. He had sold a stake and he was continuing to be the CEO, and I made him sell X amount of shares every month and put it into a large into a fund, into a flexi cap kind of a fund. And this had to be done because every year he was getting fresh ESOP also. So if you're getting 20,000 shares ESOP every year, and you sell off 1,000 shares every month, right? So on the 7th of the month you sell. So there is no question of SEBI saying you're doing insider trading or things like that. You're not doing insider trading. You're just selling every month. 7th of every month you're selling 1,000 shares. This is the way I thought he should reduce concentration risk. Now people take a concentration risk and then they say, oh, I hope I'm right. I don't think fear and getting carried away, euphoria, both are bad, and both are people get into, I hope I am doing well. Well, when you have 20 crores net worth, out of which 17 crores is HDFC Bank, there is something wrong with you. You're not doing well. You're taking too much risk. Are you diversified enough? No. So these are the things which he should, the financial advisor should talk about him, talk about the history of what he has done in the past, how he stupidly sold off some ESOP and how he stupidly invested in some bad fund house, right? So all these things will be there. To use his own past experience, means client's own past experience, the advisor's past experience and history. I mean, just keep repeating this. Markets have always recovered, right? So if you take a fund, take any long-term fund, whether it is iPro Discovery, whether it is HDFC Top 100 or HDFC Flexi Cap, all of them, or Nippon Growth, all of them have a lot of history. Go and look at their history. They've definitely gone down in value, but they've definitely come back, right? So that's important. So those are some of the moments of clarity that the investor realizes that, look, this is what happened, this is what can happen, this is what Subra said in his video. So all of us have made mistakes. All of us have in the past worried about temporary fall, and we have seen that the market has recovered. So if you are in a well diversified portfolio which is multi-asset, you have got gold, you have got silver, you have got equity, you have got REIT, you have got debt, just make sure that you're happy with the allocation. That's what a financial advisor or consultant can do. If a person is closer to retirement, you want assets which will be less volatile. Maybe gold is also very volatile, so you may want to sell some gold, you may want to buy some silver, you may want to sell some equity, you may want to put some money in gilt funds. All those things are possible. So sit down, review, and once you've done a review, you say, unless the market falls another 20%, we are not reviewing this portfolio. If it falls 20%, we may do reallocation, we may sell off some debt and put that money into equity, because equity might become more attractive. Also, taxation has shifted in India from 3 lakhs to 12 lakhs. So that has also helped. That will also help that you can maybe go even for the dividend option, etc. So look at all of that, talk about everything, and not just the volatility in the market, and say volatility in the market has always been there. And if it's a fact-based strategy, then it's fine. You can show. See, if you do fact-based strategy and goal-based investing, and you say this, for this goal you have so much, for this goal you have so much. Understand, you can still you still have to cope with investor anxiety. So the first time when the market falls for an investor, maybe he's 23 years of age, just started an SIP, and 6 months later the market has fallen, he is bound to panic, and he does not now at this stage have a great advisor who can sit with him and talk to him. So try talking to people who do a DIY. They do a DIY even for making a will. Then see what how you can help. But largely, I think some of these factors, if you take into account, you should be able to help your investor. Thank you.